almost every time I think that we've gotten in a tight spot, it's been because we didn't have enough cash available, right? So the deal can look great on paper, and it can actually, even at the end of the year, the financial statements show that you made money. But if you don't have cash to pay the light bill and pay your bank the mortgage note every month, like, then you're in trouble. And so cash flow is like a major thing. And every time we've gotten in trouble is because, I guess you could say we were undercapitalized going in.
Okay.
Right. And so
that's a great tip.
Just like raise more money than you think you need. If you think you need 250 in CapEx money, you probably need 500.
Yeah. And then when you're operating, put more aside for reserves to cover all those. Because there are. Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? Scott Kidd, the Yacht Captain Investor Podcast. Today I have my new friend, Ashley Garner, out of North Carolina. How you doing today?
Hey, Scott, I'm good. Everything is good. We were able to dodge that snowstorm, so we're happy.
Excellent. Well, like I said, we were talking earlier. If we get the snowstorm down here in Florida, where I am, we're hurting pretty bad. But
right.
We're okay here. But hurricane season will be here before we know it again. So we'll get that end of it. So
yeah.
Well, for the people that don't know much about you and like to know about you, tell us a little bit about your journey into real estate.
Yeah, sure thing. So my journey into real estate started a long time ago. I'm 54, soon to be 55. And about 40 years ago is when I really started. So I was like, ninth grade or so. And, my dad started buying these old houses near the campus of a major university. And then we would renovate them, internally subdivide them into individual apartment units, and then we would rent them out to students that were going to the college. So I was, I had a hammer and a shovel, and I was doing the work, and then kind of worked my way up to management and acquisition and financing and legal and all of those things. And I like to say I've never had a quote unquote real job, which really means I've probably worked harder than I would have, but it's always been in real estate.
Cool.
Yeah.
Very nice. And it's mostly been in North Carolina?
Yeah. So I grew up in Morgantown, West Virginia, but
okay.
All of my family and all of and my life now is all North Carolina. We still own, actually, those houses I mentioned. We still own 6 or 8 of those houses in West Virginia that we still rent. Yeah.
Morgantown is that University of West Virginia?
Yeah, that's right. Yep.
Okay, that's cool. It's a pretty area of the country. Really,
it is. Except that I think it's like 5 degrees up there today instead of 50 like it is here.
Yeah, that can be tough, but I would imagine. What is your focus? For the last 40 years, how has it evolved and built into what you have today?
Yeah, great question. So it's basically gone from a very literal mom and pop hands-on that in the start, and I think I've evolved. Well, my personal goal, once I started doing on my own account, buying things, I started the same path that probably a lot of people do with single families and then duplexes and triplexes.
Yeah.
And what I realized, again, I kind of relearned it, I guess, but, or maybe it's a different realization when it's your own money and it's your own stuff, but that this stuff really works. And the more it would work, the more hooked on it I would get. And, I set that goal that probably a lot of people have of being, having financial freedom, which to me was, if I could just make enough to cover all of my bills in my existing life and nothing changed, that I knew I could survive without, doing something else, then I knew I was like, all right, I'll be okay. And so I decided I needed to buy larger units, because I quickly realized that at single family and duplex pace, that I was already mathematically eliminated, meaning I was probably, my average life expectancy, I was going to die before I got to this goal, right?
I've never heard anybody put it that way.
Yeah.
That's interesting math.
Yeah. So I was like, all right, well, if I'm going to get there, I got to go faster. I got to get there faster. And so that's why then I bought a 10-unit place. That was back in 2013, and I still own that. And then a 32-unit place, and then 35 units, and most recently, it will be a year coming up in a couple weeks. So 11 months ago, we bought a 196 unit place.
Nice.
And then our goal going forward is to try to get to 1,000 units at, 200 units or more each purchase. That's the goal.
Okay. I see. Okay. No, that's great. So you've gone up kind of organically as you learned and got bigger and bigger, and realized that it's just, because I made the same realization as well, is that I'm never going to get there, because originally it started out, I'll just buy a house every couple of years while I'm working on the boats, and then, I'll have 10 and then I'll be good or whatever. And then I realized that was going to take a long time. And the one, it's like I was only making a few $100s off each one. And it's like, well, I really need about 50 of these. And it's like, well, 50 is going to be, I'm not going to be able to manage that. And then I'll have to pay a manager, whereas if I get a building. And I learned about the multifamily stuff and other commercial real estate. And then that went way into some stuff that I never even thought about, even though my first captain's job was I worked for a real estate developer. And, but it was all early 2000s. Most of that stuff was word of mouth. And a lot of as you know, dealing with these larger syndications and stuff, the really good deals are still word of mouth and kind of in a closed circuit, so to speak. You got to be invited in. But, since the Jobs Act, we're all able to kind of promote and bring a lot more people in, which is here we are today. But so what is your specific asset class that you like to focus on? And, are you Class A, or are you doing value add, or are you doing stabilized? What's your thought process on what's going on in the market today?
Yeah, so I think we are evolving on that point also. So historically, even back from 15 years old, it's always been a value add, and so we would buy things that were distressed or in really like unlivable condition, for example, right, and then fix them up, fully lease them, and add the value that way, and which is a great strategy.
It works.
And it works. It still works, and
it'll always work.
It will always work. Yeah. But what I think we have found. So this when we went from the 35 unit to the 196 unit. Even though the spreadsheet, like the basic business is the same, right? You got to rent the unit, you got your income and expenses, and what's your NOI, and there you go. But the nuances of playing in that different arena was something that we hadn't really experienced before. So the financing is very different. It's good. I mean, it's attractive, but there's a lot of work that goes into it, and there's a lot of special things associated with like agency financing and things like this. So we learned that, and then as we get into the larger properties, you're 20 million and above, you need to raise a lot more capital to make the purchase, right? And so as we're going through that, now we're learning about not only the retail investors at 50 or 100,000 each, but now we're learning about private equity and joint ventures and, mezzanine debt and all these things that we really didn't ever deal with before on the smaller scale. So to answer your question, what do we deal in? It's always been kind of like a class C- to B+, and try to add value somehow. However, we think we may be shifting a little bit more towards the higher end of that, simply because it seems to be a little easier to finance, and it seems to be a little easier to raise money from the more savvy investors that are able to write the larger checks.
Yeah, I would 100% agree, because I've found the same, when I first started looking at syndications and stuff and commercial real estate. A lot of people told me that were seasoned and very experienced told me, said, well, get to the bigger deals, because the bigger deals are easier to put together. It'll have less players, and it'll be less complicated. And it didn't make sense to me until a while later, but because you have more options for financing, you have that pref equity, you have mezzanine debt, you have, larger LP check writers that are very experienced, that know what they're looking at. You're not dealing with the average retail investor. You're dealing with the guy that will cut $1 million check or $2 million check, and it won't take much for him to look at it. It'll be a quick no, or maybe, well, right now I got money tied up, catch me in 3-4 months, that
right.
kind of thing, and the private equity, they're usually quick to say no. And if they say maybe, then that starts a different conversation, that hopefully you get to a good, they go through their really strict underwriting, which I'm sure you found that their underwriting can be very stringent, especially, family offices. A lot of it, sometimes they lead from their heart. If they like you, it's a different story than, they want to see what your whole overall business plan is. With private equity, they can put you through the ringer, so to speak. But if you make it through there, then they're in, and they don't want to just do one. They want to do, after,
right,
and next, and then once you develop a record with them, and so it was, to me, it was counterintuitive. I thought that, well, they couldn't make like $100 million. Like, not everyone has that, but there's guys that are telling me now, well, if it's not at least 200 million, we don't want to even look at it. And
that's amazing.
Every threshold, it's we're not dealing with anything other than 300 million. And it's like, okay, well.
Yeah, you have to force yourself to expand your brain, right? Because there's always somebody that has more money, and there's it's just, it really is the limiting factor is your own point of view. Really.
Yeah, your own mindset, really, because if you can think it, everything around us was a crazy, wacky idea at one point. The neighborhood I'm living in, somebody came up with the idea to build a couple thousand homes right here, and somebody did it. Well, not just one person, but that's what is even more important, is the team dynamic as you get into bigger commercial real estate, because you cannot do it alone, and you
That's
probably have one guy on your team that deals completely with the finance guys, and then one guy is dealing with our underwriting, another guy is dealing with asset management, another guy's, the in-house manager managing the actual property. And then, to your point, once you get to 190 units, that property can afford to hire. You can hire those people in-house to manage that specific property, and you can do all those checks and balances and systems inside. Whereas if you have 10 single-family homes, it doesn't really provide for that. And if you pay for a manager, that's most of your profit there. So unless you're doing it yourself, it's harder, but if you can do it that way, or you have a partner that can help doing that, then you can scale up organically a lot quicker. But if with 190 units, the rule of thumb is kind of one employee for every 50 or so units, kind of, that's a soft rule, but that's nothing hard and fast, because nowadays with AI, you can implement a lot more processes where you don't necessarily need that much boots on the ground. But I would not recommend you having anyone having these properties without having somebody with eyes and hands on it.
100%. Yeah, management is the key to everything. Success or failure, it's definitely property management is the main thing.
Yeah, and on that point, have you implemented any of these type of management tools in your business, like for underwriting or for, property management with any of these AI tools?
Yes. We haven't firsthand experienced the property management or the effect on property management yet. However, I read all these projections and studies, and it makes total sense to me that what ultimately, and this is good and bad, right? It's good that your bottom line will increase because payroll is one of the top 3 expenses.
Yes.
And if you can save on payroll, that goes straight to the bottom line, and your NOI is higher, therefore your value is higher. It kind of stinks that somebody may lose a job, but I also think that the AI is probably going to open up new jobs that don't even exist yet. So I don't think it's going to be a net negative. I think it's probably going to be a net neutral.
Yeah, either a net neutral, and I think it might even be a net positive because of a lot of the job creation and stuff. Because, look at all the much more creative positions because of AI that have expanded upon that. Now there's things that are going on now that weren't even jobs, 5-10 years ago, and I would say one thing that will never go away, especially in this such a relationship driven business, is that the human interaction piece of it, like dealing with the residents and investors and everything else. No one's going to invest in an AI bot. There's still majority of people are going to want to talk to somebody, and they're going to want to know, hey, what's Ashley doing? Let me just give him a call, or let me just talk to him, or go to his meetup, or go to his office and talk to him for a little bit, get on a Zoom call, and the property management piece, dealing with an actual person, you're going to have a higher rate of retention in those buildings because people feel like they're being, their wants and needs are being serviced and stuff like that. Whereas if it's completely automated and they are having an issue and nobody comes, hey, how did that work out for you? Could we do anything better? If you just get a chat bot asking that, you're going to be like, whatever. You probably won't even answer it, but if somebody comes by your place every so often and goes, hey, how's everything going for you here? Do you like living here? We're doing an event here, a barbecue on the Sunday, like everybody to meet their neighbors and stuff like that, build an actual community, because happy residents, happy investors, there's just no way around it. And all of that cannot be done without people.
Oh, yeah. I completely agree. I think the relationships are the most important thing, from whether you're buying a single family or whether you're buying 400 unit, $100 million property. It's all the relationship, and that's really the key to everything. Yeah, I would agree with that completely.
Yeah, I know this from experience, and so I'm just in any business, and especially being on the yachts too, like. What we do, we live and work together. So having a team and working hard with the team for the guest experience is paramount. And for me, I try to take those things and bring them over to the real estate side, because I want the residents, the people that are leasing commercial space and everything else, for them to want to be here, be there, be happy there, and feel like their needs are being filled, or we're solving some kind of problem for them. Because if not, then what are we really doing here if we're not providing a good service? If we're only 100% completely money driven, then it's going to be, everything we do is transactional, and most people see through that.
Oh yeah, it doesn't that's not a way to build a long standing business and reputation.
No, it's
for sure.
Transactional is short term, and the relationship is long term. So, what are you guys? Are you guys looking at anything specific in North Carolina? Any certain markets you like more than others, like Charlotte over Wilmington or Raleigh?
A lot of the towns of any size, the population is growing so quickly that it's kind of hard to go wrong with the demand. So the demand is there for sure. Now there are lots and lots of tiny small towns that we would not want to invest in, but Interstate 40 runs kind of across the whole state. If you stayed right there on Interstate 40 and kind of picked a town of any size, you'd be great. You'd be fine. You'd be from Asheville to Hickory to Statesville and Charlotte, Greensboro, Winston-Salem, High Point, Raleigh, Durham, and Wilmington. So really any of those markets, some of them are priced higher than others. So the returns, they vary a little bit on what cap rates and things like that. But they're all very attractive, and they all have plenty of choices. So from D class that we would not invest in all the way to A plus brand new stuff. Yeah, there's tons of stuff.
Yeah, I know from just living in Florida for quite some time now that there's a lot of people that moved down here over the last few decades from New York and Boston and New England, and by moved here, I say they live here 181 days out of the year, so they don't have the tax. They still go up in New England for the summer, and I don't blame them because New England is very nice in the summertime. For sure.
Yeah. Sure.
But a lot of them are moving to South Carolina, North Carolina, and you're seeing they're starting to call them, I don't know if you've heard this term, halfbacks.
Oh, yeah.
They go halfway back.
Yeah.
And I would imagine that adds to the market dynamic for you guys.
For sure.
Because the climate's mild. I've been to North Carolina many times. We sometimes go up into the mountains there, out there by Asheville and stuff like that. We've been up there. We went there one time, and we really enjoyed it. It's a pretty part of the country, and it's the quality of life is pretty good there. People are nice. There's a lot of good places to go. A lot of outdoor activity. Yes. And do you guys specialize in any type of, multifamily, like near city centers, walkable cities? Does that play into any of your strategy?
It hasn't been something that we kind of, I'd say we've been more spreadsheet driven, and meaning like if we think that we can buy it based on its actual performance, real life performance today, and make the returns. And in other words, we're not buying it hoping that we can raise the rents after we put a bunch of money and work into it and then make the returns. We don't like that. So in other words, so we haven't said we're only going to invest in walkable or eco-friendly or any. We'll kind of look at everything as long as the spreadsheet works.
Yeah. Yeah, well, I would agree with you because I know a lot of people got into trouble by thinking they could just continuously bump the rents, and you saw the softening of the last year and a half, 2 years, or what have you, where they spiked up and then they kind of flatlined, and some places have gone down. You see, like Austin, Texas, they gone down because they've oversupplied. Northern corridor of Dallas is kind of moderated because we're doing some development stuff in the southern part of Dallas, which is secondary markets, which is a completely different animal than the north part of Dallas. So people are building those 500,000 unit multifamily where it's very ultra competitive, and it's up there, the absorption is a little bit slower, and down south in that I-35 corridor, like where you're talking about I-40, we like that I-35 corridor because I went to University of Texas at Austin.
Oh, nice.
From Austin down to San Antonio was all farmland and stuff, and San Marcos was right in the middle, and now that's all filled in. That's all one thing, and then we see the same thing from Austin up to Dallas. It's just a matter of time that all that's going to fill in, and I see your strategy there with the I-40, going across, like anything that's probably 100,000 people or 50,000 or more growing, you're probably taking a hard look at.
Yeah, for sure. The location certainly fits, and then we just have to make the property work. But yeah, you're right. I feel like in both of those spots, Texas and North Carolina, you're kind of in the path of progress.
Yes,
so that's in your favor for sure.
Yeah, that would be a more correct term of path of progress, because it's going to fill in. Anything within an hour of a big city is probably going to fill in. Because now that we also have the hybrid work from home and office. If you're within an hour, you're probably going into the office 1 or 2 days a week. So an hour is not so bad if you're living out there, if you like where you're living.
Good point. Yeah.
So then 3 days a week you're at your home, so more people are going to congregate there, and then more businesses and stuff will come up there. And also, North Carolina has a big push towards finance. You're getting a lot more of the tech-driven stuff too, and I know Charlotte is one of the big finance centers. That's I think probably the largest one outside of New York.
For sure. The banking and finance world is very strong there. Yeah.
Yes, and is there any other industries you see that are moving to North Carolina that you like to follow a little bit?
We have one of its claims to fame is all of the secondary education. There's so many like colleges and universities here, and so there's such a high supply of very well educated employees that you tend to get a lot of tech companies, you get some manufacturing, things like that. But I think we're seeing more and more tech businesses, or because of what you said before, how you can work from anywhere. I've got a lot of personal friends who are employed out of Florida or New York City or wherever, and they live here, and they either work at home or they rent a little, they like a temporary office space, and they call that their office, but they're every once in a while, once a week, maybe they fly to New York City.
Yeah. No big deal. Yeah, it's become a lot more common. I know especially sales guys have always been able to do that. They're usually out meeting with clients or on their phone anyway, so they don't necessarily need to be there. But they do for the monthly or every couple of weeks strategy meetings. They probably got to go to the office.
Yeah.
A lot of them are within an hour of an airport. I know my brother and a couple other friends, they got to be within an hour of the airport. And
that's right.
As long as they can get there, it doesn't really matter. And the company's paying for their accommodation when they get there anyway. So because that costs that company substantially less than paying for a desk full time.
That's right. Yeah.
Or they pay them a stipend to be at home and stuff. And so those are a lot of unique things going forward. Like, what are you seeing that are trending that you see more people looking at when purchasing properties and stuff, especially multifamily?
That's a good question. What are they trending towards? Amenities are a pretty big thing, and so the tenants want nice stuff. They want things to do. You mentioned walkability. Anytime you can have all that together, I think sets you apart. We've even got, like, so the 196 unit place that we bought, it's an older place, but it's in good solid shape, and there is some value add we can do. But one of the things we liked about it also was that it had amenities that you would find, maybe they weren't the same condition or the same scale, but the same amenities you could find in Class A, and this would be like a B plus, C plus, B minus property. So in other words, we've got the dog park, and we've got the gym, and we've got the picnic areas, and we've got all these things that a lot of our exact competition didn't have. And so I think that gives us a competitive advantage because, people they want to have this stuff where they live. They don't want to have to drive across town to go do things. And if they're given the choice to have the amenities on site, then I think they'll pay for it.
Yeah, we're seeing the same thing because it just makes sense that these highly amenitized places are really important for the residents. It's about their experience. Even if they don't hardly use it, so they need to know that it's there. The dog parks, that's a whole nother thing because that gets used a lot.
A lot. Oh yeah.
And little things like community areas and stuff where people can use pools, gyms, walkable space, where track around the places are, it might seem like a small thing, but some people, might really, be attracted to that place because the other place doesn't have it, but you have a nice green space. And, if you set up events and stuff for the community and stuff, hey, everybody's going to go, have a little message board. Hey, a bunch of people are going to go walk in the morning. Feel free to join in. Things like that are really important for, because people want to be a part of, feel like they're a part of a community.
That's right. Yeah, even if they don't, you see a shift away from maybe owning homes, that quote unquote American dream may be changing a little bit.
Yeah.
But the desire for what you just mentioned has not gone away. You still want that pride of ownership, the community, feeling like this is my home, even if I don't own the deed to it.
Yeah.
Right?
Yeah,
for sure.
When you get to a certain level of residence stuff, people are going to take a little more, be a little more responsible with where they live and stuff. Because no one necessarily wants to live in a bad area.
Nobody.
It's not really not really a choice anyone would take. Would choose. So why not make it nice for the residents and stuff? And as we move forward into that, like renter nation, like you're seeing, and we're seeing a lot of places because the affordability is there, not just in purchasing, but you're also seeing it in some places in rents as well. So, the best way I see is just to increase the supply, rehab a lot of these older places like you're talking about. They don't necessarily have to be really old, but some of these places need updating to make them nicer to where they're attractive for more residents. But what are you seeing going forward for like 2026 and 2027, and especially in the multifamily space? Because I know we were discussing before the call, 2024, 2025 was kind of rough for multifamily.
Yeah, I think that on the buying side, I think we will see some better opportunities to buy things because I think maybe some sellers are realizing that, hey, the interest rates aren't going to drop back to whatever they were. And, plus not everyone can hold on. If you bought, if you're a fund or you're some kind of syndicator and your business plan was 5 years, well, it's time to sell it. And, you maybe can't wait, or maybe whatever, you wish it was the price it was 3 years ago, but it's not. And so, or you may see some distressed things coming out. Rents have been flat, expenses have gone up, interest rates have stayed up, and all of those things might be working together to make it hard on some folks, and they may need to sell something. Right now we're refinancing this larger property to a HUD 223F 35-year loan, and our interest rate, we haven't locked it yet. We'll do that probably in like 2 weeks, but the application was put in at 5.5% interest. And so, you lock an interest rate at 5.5% for 35 years. In other words, our first monthly loan payment will be the same exact amount as the last loan payment that we make when I'm 90 years old. Yeah. And it's just like blows your mind, like, because that the rents are going to go up and things, property values are going to go up, but our loan payment is going to stay exactly the same.
Well, that's great.
That kind of stuff, I think I think we'll see more of that come available.
Yeah, I think so. I think you're absolutely right. You'll see more of those long-term fixed loans. Government. And it's a HUD loan, so it's government backed, and that's the unique thing about multifamily. For people that are listening that don't know, those are government backed loans that are specific products designed for multifamily and multifamily only. You don't have it in any other commercial real estate. You don't have it in medical office or, industrial or storage or anything. It's because they want to make sure that there's incentives for people to invest into multifamily real estate, because people need to have affordable places to live.
Mm-hmm. Yeah. So I'm glad you mentioned that incentive. The government wants to make sure that people like you and me are providing housing, so that the government knows they can't provide all of the housing for everyone, right? So they incentivize people like you and me, and that special financing is one way, and another way is that depreciation.
Yes.
And the bonus depreciation came back in 2025.
Yeah, that's been great.
So how about this example? So we just the quick numbers that are in my head right now. We're not finished finalizing the K1s yet, but they'll go out. This is late January, so within the next couple of weeks they're going out. But for a $100,000 investor in the most recent property that we, the 196 unit, for every $100,000 of investment, they're going to get somewhere between $135,000 minus on their K1. So if you invested $300,000, you're going to get a minus of $375,000. And if you are in a 30% tax bracket and you also have the passive income to use it against, that's going to save you $100,000 in cash money right now. And so that's like a third of your investment back, in the first year. It's like,
and this is just one example of what can be done. 100% depreciation is great. And then I just want to qualify this in case any of these CPAs are listening. Neither of us are CPAs or attorneys. So these
far from it. Yeah.
Make sure you consult your experts. But no, that is one prime example of being able to use that to your advantage. And another one I would add is those opportunity zones as well, where you can defer the capital gains forever, or you can get them expunged if you hold the property for 10 years. There's so many things when you dive into it, and I'd recommend, if you're just learning about this, go talk to a CPA or a property attorney about these advantages, because there are a lot more than you know, and talk to other investors like Ashley here, which can give you the rundown of all these different advantages that he's used for 40 years. But do your due diligence, figure out what works for you.
Right.
Well, this has been really great. I really appreciate you coming on, Ashley, and I look forward to following up with you in a little while. See how the year played out for you and everything. See how it went. See what worked, what didn't work. And one thing I wanted to ask you before is I'd like people to share like a real quick deal that didn't go well and how you got out of it.
Yeah, man.
How you solved it.
We might have to start over, go for another hour if you want me to get into that. So almost every time I think that we've gotten in a tight spot, it's been because we didn't have enough cash available, right? So the deal can look great on paper, and it can actually, even at the end of the year, the financial statements show that you made money. But if you don't have cash to pay the light bill and pay your bank the mortgage note every month, then you're in trouble. And so cash flow is like a major thing. And every time we've gotten in trouble is because, I guess you could say we were undercapitalized going in.
Okay.
Right. And so
that's a great tip.
Just raise more money than you think you need. If you think you need 250 in CapEx money, you probably need 500.
Yeah, and then when you're operating, put more aside for reserves to cover all those, because they call them incidentals, but these incidental things happen all the time.
All the time. Yeah, I mean, I had 3 incidental things happen last week. I was like, oh my gosh, why do these things keep happening? And it's just because it's not anything special; they just happen.
Yeah, it's little things that compound. I tell people is anything you want to do in life is a lot of work. Being broke and not having any money, that's a huge amount of work. If you get a flat tire, you're walking.
That's right.
Stuff like that. Your battery goes flat, you're walking.
That's a good point.
It takes longer to get there, so why not put in the hard work to get further ahead? And those incidental things, you put those little reserves ahead like you would do in your own personal life. Just keep building on that. If something happens, I mean, sure, you're going to get upset. Oh, geez, that's pretty bad. But you got that buffer to where, you have that reserve. But it's hard to know where that is because you never know what's coming. All of a sudden a storm comes and you got to cover the roof until the insurance can cover it. The insurance is not going to come for another 6 months to fix your roof. You got to go out of pocket to do it.
Right.
You're either looking at a short-term loan or you're looking at going out of pocket to cover it. And either way, you got to get through that patch. And that's just one patch if something else doesn't happen.
Exactly. That's exactly right. So that's been the time that we've ever gotten in the most trouble was just the cash thing.
Yeah, I think that's
you just have to work your way out of it.
That's a great tip to tell people always, always overcapitalize, always hold more in reserves than you think you'll need because you will need it at some point.
Yeah.
It won't hurt you. And if at the end, the end of the year or the end of the term, say you're going to do this for 2 years and you got more in there, then that's more money you can give back to the investor.
Yeah. For sure. Yeah.
And that will also reinforce with your investors that, hey, you're looking out for their best interest. Hey, we could have given this back to you, but we're going to hold it a little bit longer just in case because we're not really sure where things are at. So we're just going to hold it. And I invest as an LP as well. So when I hear them say that, it means and I can see it in the account or whatever, that makes me feel better because I'm like, okay, they're not just running on these thin margins because, I've been there in my own life where you ran on these thin things where you're cash poor and something happens and you're like, oh man,
it's a stressful existence to do that. Yeah, it really is.
Most definitely is. Well, this has been really great. I appreciate you coming on. And for people that want to find out more about what you're working on and find out more about you, where can they find you?
Yeah, I think the easiest place is go to our website, which is abgmultifamily.com. And from there, you can get to the other places like LinkedIn and YouTube. And we're pretty active on LinkedIn and YouTube. You can find us there also. But the website is abgmultifamily.com.
Perfect. Well, like I said, this has been great. I really appreciate you coming on and sharing your stories. And I look forward to us speaking again.
Yeah, we would definitely would love to stay in touch, and I appreciate the opportunity.
Well, thank you so much. I'm Scott Kidd for the Yacht Captain Investor Podcast. And just a reminder that the best investment you can make is the one you make in yourself. So just keep investing in yourself. Thank you.